What's up, everybody? Welcome back. Patrick here, moving on with the video series on M&M propositions with taxes. This is part 2 of the series. And in part 1, what we concluded was the value of a levered firm is equal to the value of an unlevered firm plus the present value of the interest tax shield. And this is M&M proposition 1 in the case with taxes. And at the end of that video, we also said that there's different ways to calculate this present value of the interest tax shield depending on what is happening with the debt. So let's show how this works through an example. So let's say we have a firm and it's currently unlevered with 1 million shares, each priced at $50. The firm is debating of changing its capital structure by taking 20 million in debt and repurchasing shares. It will pay down this debt by 4 million every year. If the tax rate is 40% and cost of debt is 8%, what is the value of the restructured firm? Now, whenever I get a question like this, I always like to draw out any potential balance sheets that I can. So currently, it says that this firm is unlevered. And what that means is that there is no debt on that right side of the balance sheet. It's all equity. And we are told that the firm has 1 million shares of equity and each is priced at $50. Well, that means that the value of the equity is 50 times 1 million, which is 50 million. And because it's unlevered, equity is the right side is made up of all equity. That means the assets have to be worth 50 million as well, which means that this firm, this unlevered firm, has a value of $50 million. The value of any firm always is just the value of the assets on the left side. So the value of this unlevered firm is $50 million. Now, they're thinking of changing their capital structure. And what they would do is take on $20 million worth of debt and then repurchase shares. So debt would go up and equity would go down. So let's draw out a balance sheet for the restructured firm. So we have the assets. We know that now this firm is going to be levered. It's going to have, what, $20 million worth of debt? It's going to have some amount of equity. And it's going to have some amount of assets. Now, if you remember when we were dealing with M&M propositions without taxes, basically the value was always consistent. So this 50 million would be the same here. So we know that this equity here would be 30 million. However, because we are now dealing with taxes, the value of this levered firm is going to be higher than the value of that unlevered firm because of that interest tax shield. And so what actually happens is that the equity rises in value. We don't know by how much yet, but it's definitely not just going to be 30 million in order for that right side to be a total of 50 like it was in the current firm. It's actually going to be worth more than 30 million because of that interest tax shield. So what we have to do is we have to find out what the value of this levered firm is. So that's what we are finding, VL. And we can find the value of that levered firm with M&M proposition 1 that we went over in part 1. Value of a levered firm is the value of an unlevered firm, which is 50 million in this case, plus the present value of that interest tax shield. So this is what we have to do. We have to find out what that interest tax shield is going to be. So how would we do that? Well, let's draw a timeline for what is happening with the debt of the firm. So we know in time 0, this firm is going to have $20 million worth of debt. Today, they're taking on $20 million worth of debt to repurchase shares. And what they're saying is that every year, the firm is going to pay down the debt by 4 million. So the debt is worth $20 million today. Well, in 1 year, the debt is going to be worth 16 million. And then in time 2, debt would be 12 million. Time 3, it would be 8 million. Time 4, it would be 4 million. And then by year 5, it's going to be fully paid down. So notice after year 5, we're not going to be getting any interest tax shield anymore because there's not going to be any debt. We're not going to be paying any interest. So what we have to do is we have to figure out what interest are we paying every year on this debt. Now, interest is usually paid throughout the year. However, if you remember from the leasing videos, any tax shields you're usually getting at the end of the year. So we can assume that the interest that we're paying on this debt of 20 million today is going to be paid in 1 year. And the amount of interest is basically the 20 million times the cost of debt, which is 8%. And 8% of 20 million is 1.6 million. So one more time, the interest that we're paying at the end of the first year is based on the debt at the beginning of the first year. So we take that 20 million, multiply it by 0.08 to get 1.6 million. And then the interest that we pay at the end of the second year is based on the debt at the beginning of the second year. So we would take 16 million, multiply it by 0.08, which would give us 1.28 million. And then so on and so on. So here, at the end of that third year, 12 million times 0.08, that would give us 0.96 million. And then 8 million times 0.08 would give us 0.64 million. And then 4 million times 0.08 would give us 0.32 million. Right? So that interest we're always paying at the end of each year, and that interest is based on the debt amount at the beginning of each year. So there's these sort of timing differences like we saw in leasing. And then finally, this is just the interest portion. So this is the expense that's going to show up on the income statement. Well, if you remember from part 1, how do we calculate the tax shield? We take that interest expense each year and multiply it by the tax rate. And the tax rate in this case is 40%. So to calculate the tax shield for that first year, we would take that interest of 1.6 million and multiply it by 40% by 0.4. And when we do that, we end up getting 0.64 million. Same thing here, 1.28 million times 0.4 would give us 0.512 million. And when you follow that same process, you end up getting 0.384 million, 0.256 million, and then 0.128 million for the tax shields in years 3, 4, and 5, respectively. And then remember, after year 5, there's no more interest tax shield because the debt is paid down. There's no more debt, hence we're not paying, or the firm is not paying, any more interest. So now that we have the interest tax shields for every year, we can now find what the present value of all of those tax shields are in time 0. And once we have that, we can simply find the value of that levered firm. And to do that, you can just simply take these tax shields and throw them in your financial calculator. So CF1 would be the tax shield in year 1, 0.64 million. Let's just convert that to millions. So that would be 640,000. CF2 would be 512,000. CF3 would be 384,000. CF4, 256,000, and then CF5 finally 128,000. And then you always take the present value of the interest tax shields in this chapter at the cost of debt. So the interest rate that you're going to present value all of these is 8%, and then you're just calculating or you're using that MPV functionality on your calculator to calculate the present value of all of these cash flows. You may also have to input CF0 equals 0. There's no cash flow for time 0 in order to get to CF1. But yeah, once you input these, input that interest rate at 8%, and then you calculate the present value. And when you do that calculation, you end up getting $1,611,664. So that there represents the present value of that interest tax shield. And now, since we have that, and we have the value of the unlevered firm, which is $50 million, we can find out what the value of that levered firm is. It's basically equal to $50 million plus that present value of the interest tax shield. So the value of the levered firm would be $51,611,664. So that's the value of that left side of the balance sheet for the restructured firm. And then notice how we can find out the equity value as well. We would just take this 51.6 million minus 20 million, and we would end up getting 31.6 million. And then in future examples, we'll go into more detail with this equity, finding what the new share price is, etc., etc. But for now, I just wanted to figure out what's the value of that levered firm, what's the value of that left side of the balance sheet. So all you do is you find the value of the unlevered firm, find the present value of the interest tax shield, and then add them together to get the value of that levered firm. And this here, notice that we're paying down the debt. So you may want to label this example as temporary debt, meaning that the debt is not going to last forever. Notice that it ends up being 0 in year 5. However, there's also examples where there could be permanent debt, meaning that the company or a firm would, for example, keep this $20 million worth of debt forever and then just make the interest payments every year. So let's do an example where we are dealing with permanent debt. So we have an all-equity firm that currently has free cash flows of $10 million a year and a cost of equity of 10%. They will take on $30 million worth of debt and repurchase shares. If the firm only plans to make interest payments, the interest rate is 6% and tax rate is 40%, what is the value of the levered firm? So as I did in the previous example, what I like to do is try to make any sort of balance sheet that I can. So we have an all-equity firm, meaning that this firm is unlevered currently. So we know that its balance sheet, we're going to have assets on the left side, and then we're going to have equity on the right side. However, notice that the information that we are given in this question is a little bit different than the information in the previous question. In the previous question, we were given the number of shares and the share price, so it was really easy to find that equity value, and that was the assets value as well. In this case, they say that this firm has free cash flows of $10 million a year and a cost of equity of 10%. Now, if you remember, when we were talking about M&M propositions without taxes, I mentioned that the firm value was always equal to the earnings before interest and taxes times 1 minus the tax rate all over the weighted average cost of capital. Now, you can actually generalize this numerator as well. Depending on the textbook, some textbooks will say that is the earnings before interest and taxes times 1 minus the tax rate. Another set of textbooks might say that it's the free cash flows over the weighted average cost of capital. So just be aware of which one your textbook is using. So in this example, I decided to put free cash flows instead of giving you the earnings before interest and taxes and the tax rate, etc., etc. So following this here, we can calculate what this unlevered firm value is. Because if you think about it, if a firm has all equity, that means that the weighted average cost of capital of that firm is equal to its cost of equity, because that equity makes up 100% of the firm. So that debt portion of the weighted average cost of capital formula is going to go to 0. So we can calculate this firm value by taking the free cash flows of $10 million and dividing it by its weighted average cost of capital. But since it's all equity, its weighted average cost of capital is basically the cost of equity, which is 10%. So this would be 0.1 there. That 10% you have to put in decimals. So when you do that calculation, you end up getting 100 million. So we know that this unlevered firm here is worth 100 million, and that means that its equity is worth 100 million as well. So we have the value of the unlevered firm, but they want the value of the levered firm after we go through this restructuring. So let's draw a balance sheet for the levered firm. What can we draw so far? Well, the value of the assets, we don't know that yet. We're actually finding that. That's going to be the value of the levered firm. And then the right side of that balance sheet is going to be 30 million worth of debt, the debt that we took on to repurchase the shares, and then the equity we don't know yet. So what we have to do is we have to calculate the value of this levered firm with M&M proposition 1. So it's the value of an unlevered firm plus the present value of the interest tax shield. Now notice in this question they say that the firm only plans to make interest payments, and whenever you see that, what that means is that the firm is going to have permanent debt. So this $30 million worth of debt, they're not going to be paying down like in the previous example. They're going to maintain that $30 million worth of debt. So if we draw a timeline, in time 0, they're going to have $30 million worth of debt. In time 1, 30 million. In time 2, 30 million, and et cetera, all the way to time infinity. Now, same thing as the previous example, the interest is always going to be paid at the end of the year, and it's going to be based on the value of the debt at the beginning of the year. So to find the interest, what we would do is we would take 30 million, the value of the debt at the beginning of the first year, multiply it by 6%, so 30 million times 6% gives us 1.8 million. That's going to be the interest in the first year. It's going to happen at the end of the first year. It's going to be based on the beginning debt value. And then same thing here. It's going to be 1.8 million. They're going to be paying 1.8 million worth of interest every year forever. And then what we can do is we can calculate the tax shield on that interest. So we would basically take that 1.8 million interest expense and multiply it by the tax rate of 40%. And 1.8 million times 0.4 gives us 0.72 million. And then same thing in year 2. And again, that is happening every year forever. So notice that this tax shield, it's not a finite number of times that we are getting it, like in the previous example. It's an infinite amount of times, an infinite amount of cash flows. So notice that this is a perpetuity. So to calculate the present value of the interest tax shield, in this case with permanent debt, we would just basically take the cash flow in one period, so 0.72 million, let's actually write that as 720,000, and we're going to divide it by the cost of debt or the interest rate. Both of those are the same, which is 0.06. Right? This is the formula for a perpetuity, if you remember. It's the cash flow over the interest rate. And this is a perpetuity because this tax shield we are receiving forever. And when you do that calculation, you end up getting 12 million. So that is the present value of the interest tax shield. So let me actually split this up here. So this is the interest tax shield, so now we know what the value of the levered firm is. It's the value of the unlevered firm, 100 million, plus the present value of that interest tax shield of 12 million. So that is right there, 112 million. And it's also easy to find the equity, even though we're not asked for it. We can just simply take the assets, subtract the debt. So 112 million minus 30 million gives us 82 million. So that is the value of the equity of this levered firm. And as I mentioned, we're going to go into more detail about what happens with this equity in future examples in this chapter. So that's what happens when a company has permanent debt, meaning they're only going to be making interest payments, and that 30 million is going to stay with the firm forever. And in my opinion, it's a lot easier of a calculation to find that interest tax shield when you have permanent debt, because it's just simply a perpetuity. Versus if you have temporary debt, that interest tax shield is changing every year, like you saw in the previous example. So you got to do separate calculations, and then you got to throw in different cash flows in your financial calculator. It's just more work, in my opinion. So this is how you find the value of a levered firm with permanent debt. Now, before finishing off this video, I want to make a quick point about permanent debt. Just generally, how do we find the present value of the interest tax shield with permanent debt? What did we just do? Well, it's basically equal to the tax shield, the interest tax shield that's happening every year, over the cost of debt. Right? It's just a perpetuity calculation. We just did that. Well, how do you find this interest tax shield? It's basically the debt of the company times the cost of debt times the tax rate. So this formula here is what the interest tax shield is. We went over this formula in part 1 of this series. And then we're still dividing this by the cost of debt. Right? Because it's a perpetuity. And notice here how the cost of debts cancel out. So whenever you have permanent debt, you can actually simplify this present value of interest tax shield process into just the debt times the tax rate. Because those cost of debts cancel out. And if we actually go back to this example, notice that the debt is what? It's 30 million. Tax rate is 40%. 30 million times 40% gives us 12 million, which is what we got when we calculated the present value of that tax shield the longer way. So whenever you got permanent debt, you can simplify this whole process into the debt times the tax rate. In fact, a lot of textbooks will actually state this M&M proposition 1 as the value of a levered firm equals the value of an unlevered firm, and instead of writing present value of interest tax shield, they'll actually write the debt times the tax rate, which is this here. I don't like to state it that way personally. I like to keep it a little bit more general because, again, this assumes that the company has permanent debt. But what if we run into an example like the one previous where the company has temporary debt? Then this is not going to work. You got to calculate that interest tax shield in a little bit more of a manual fashion. So, as a summary of what we've covered so far in this video series, part 1, we introduced this M&M proposition 1, and this is with taxes. In part 2, in this video, we went over some different cases to calculate this interest tax shield with temporary debt, with permanent debt. In part 3, in the next video, what we're going to cover is the implications that M&M proposition with taxes has on the weighted average cost of capital of a firm and the cost of equity. So you can go ahead and watch that, and I'll see you guys then.